Good afternoon, everybody. Thank you for being here this afternoon. I guess let me get started by just, we have Mr. Arnold on the line with us, who's our new board member. I don't think he was at the last committee meeting, so I don't know if there's any other, if Garcia's here, but just introduction to him. He's come back with a heck of a background, and appreciate him being here, serving on the finance, or being here today for the finance committee. So I'm going to start with a call to order. We do have a quorum. Reminding me that we are streaming YouTube live. And the first order of business of approval of the minutes. Do I have a motion to approve the minutes of October 23rd, 2024, the meeting of the Finance Committee as presented? Do I have a motion? Do I have a second? All in favor?
Aye.
Any opposed? Any abstentions? Hearing none, the minutes are approved. We now hear from Mr. Blake and Ms. Chu from Clearstead regarding our investment committee report. So I'll turn it over to you, Mr. Blake and Ms. Chu.
Thank you. Good afternoon, everyone. We have a number of very good updates to share with the committee. So we'll spend the next 10 or 15 minutes going through some updates. So just as we start a new year, we want to give you a very brief update on Clearstead. We're working with about 260 different institutional clients like Metro Health, $47 billion in assets. We have a little over 250 employees, most of which are at our headquarters in downtown Cleveland. And most of all, we want to thank you for your partnership with Clearstead. On the next slide, these are the items that Claire and I will cover this afternoon. So we'll talk about the oversight dashboard, some very brief thoughts on the economy and markets. Claire will discuss performance through the end of the fourth quarter. And then we've got a quick review of the equity investments. So the oversight dashboard, as a reminder, is really the game plan for the year. And on the next page, this just details various items that we think are important to be discussing together. We're spending a lot of time with Derek and his team getting into more detail than you even see here. So we're on track. At the next meeting, we'll spend some time on strategic asset allocation. So thinking about long-term targets. The world looks a little bit different today than a year ago in terms of equity market valuations, the yield curve. So we're just going to reassess longer-term performance expectations on a go-forward basis. So on slide 7, one more slide there. There we go. So just to wrap up the fourth quarter and give some context as before Claire gets into performance, what we saw at the end of the year was the economy continue to grow. We saw inflation slow down a little bit in the second half of the year. And we saw U.S. markets, U.S. stocks outperform non-U.S. by a fair amount. And the positioning of the systems portfolio benefited from that. We did see the market broaden a little bit in the second half of the year. So as you remember, for a lot of the years, to some extent still is, these big tech companies really carried the market. And the average company, if you look up their results for last year, wasn't as good as kind of what the market might seem based on the indexes. So that broadening was a good thing. We also importantly saw in December, the Fed come out and reset some policy expectations. So initially, the Fed was suggesting 4 25 basis points cuts in 2025. In December, they came out and said, we're looking at 2 25 basis point cuts. The market would actually suggest 0 to 1 cut in 2025. And our chief economist said, he wouldn't totally throw out a increase to rates in 2025. But all that being said, we're not expecting to see a lot of movement from the Fed in 2025. That did create some upward pressure or some upward movement in yields at the end of 2024. So that put a little bit of downward pressure on bond prices. But with higher yields, that's a better place to be, especially when you think about where Metro Health's investments are. Higher yields for longer would be a net benefit to the system. As we go into 2025, what we're expecting is growth to continue. We think the consumer is relatively strong, so we're looking at full employment And some of the areas we had concerns with around delinquency rates with credit cards, auto loans seemed to level out a little bit in late 24. And we also saw traditional consumer spending rates pick up to normal levels in the second half of 2024. So we think the consumer is in a decent place. Equity market sentiment remains positive, meaning corporate balance sheets are strong. Earnings are expected to grow in the S&P 500 by 15% in 25, which is higher than 24. And then interestingly, there's a ton of geopolitical risk in the world. You all see it. But what feels different, according to our research team today versus a year ago, is there seems to be some paths for de-escalation today that maybe didn't exist in the past, and that would be a net positive. The following slide is just more information from the Fed. So expecting what's highlighted here is a little bit higher inflation with their expectation for 25 and also higher Fed funds rates. On slide 9 is earnings outlook. So earnings will drive the markets in the long run. So expecting to see about 15% earnings growth in 2025. Given the valuations we're seeing in the market, it's very important that we hit these earnings expectations, or else investors will believe that markets are overvalued and you could see some retraction. And then finally, the yield curve is on slide 10. We saw a lot of volatility, yields shifted upward in the fourth quarter. Actually continue to go upward up until the last couple of weeks. So rates, the 10-year settled down to 4.3% today. The 2 years at 4.1%. Importantly, it has a positive slope, so the debt markets are seeing growth into the future, and credit spreads are tight. So that just means that the credit markets don't see a lot of risk, at least in the near term. So spreads are tight. I'm going to turn it over to Claire to give a performance update.
Thanks, Adam. So on this slide here, we have a checklist just to show that the system's assets are in compliance with both Ohio Revised Code and your investment policy statement. On the following page, we have your watch list guidelines. So as a reminder, these guidelines were created last year in collaboration with Derek and his team as another tool to monitor your investments. So looking at the following page, we show both the qualitative and quantitative factors that we look at on your watch list. Last year results versus benchmarks were mixed, but the majority of your investments did outperform their peers, and nothing tripped this watch list last quarter. Looking at this page, we have a snapshot of the total systems assets. So the system had $547.8 million at calendar year end. The captive had $120.8 million, and combined, the total system had $667.6 million. Looking at the calendar year, it was a very strong year for investments. The reserve pool was up $9.2 million across the year. The non-reserve pool was up $30.2 million. So combined, we saw $39.3 million in investment growth across the year. Looking at the following page and the performance summary, last quarter, we saw mixed returns across asset classes, but in total, the plan was up 0.3% in the quarter. Over the last year, the total plan was up 8.5%. So far in 2025, returns are up. It was a strong January with the total plan up 1.3%. February's been pretty volatile, as you may know, but calendar year to date, you're in positive territory. The non-reserve long-term pool in Q4 was up 0.8%. Across the year, it was up close to 20%. Total equity portfolio, we saw mixed returns between domestic and international equities. As Adam referenced, domestic equities were a positive area of your portfolio, up 2.1%. Your domestic equities were up 22.3% in 2024, and that's coming off of 2023, where we saw 20+% returns as well. International equities were down 6.4% in the quarter, although still ahead of its benchmark. International markets faced a few headwinds last quarter with the strengthening of the US dollar and uncertainty with politically and economically, but we saw a rebound in international markets so far in 2025. Your non-reserve short-term pool was up 0.6% in the quarter. As a reminder, your non-reserve short-term pool is comprised of short and ultra-short duration bonds. The broader bond market was down in the quarter, but being very short duration, your portfolio was less interest rate sensitive and didn't fall as much as the broader bond market. And then your reserve pool, which is comprised of fixed income, was down slightly, down 0.2% in the quarter, although up 4.1% across the year. Looking at page 18 here, we see the captive returned 10.3% across 2024. That translated into $10.2 million in investment growth. So between the system and captive, total assets saw $50 million in investment gains. Does anyone have any questions before we do a deeper dive into your equities?
Question. Our policy, Board of Trustees 05, which deals with investments, which is what you're probably dealing with here, which is our policy, says that 25% of the reserve pool shall be in effectively safe bonds, government bonds, money market, bankers' acceptance. Are you reporting that out here? Are we getting clarity on that?
Yes, so that threshold is being met.
Is that shown here?
Could you show them, Blake, where that is on here?
Yeah, we have it on the compliance schedule page. We go through that compliance policy. There's a couple different places where that cash reserve is pulled from to meet that threshold. So it's the reserve pool itself, plus there are other cash accounts and the short-term pool that would go into meeting that threshold.
So on page 15, you'll see the reserve pool had $293 million. So the minimum's 25% or $300 million, and then in addition, there's additional cash elsewhere. And that number fluctuates and it's over $300 million today.
So everything in the reserve pool meets that, is basically meeting that, is that threshold, that's why it's reserve versus the non-reserve. Pretty much, great. So we've already said that's what separates it.
And we have it, it's on the screen now, where we summarize at the bottom of the page between the reserve pool and non-reserve pool.
So the reserve, so Mike, I mean, I hope you answer your question. So that reserve pool is conservative, that 293 million, and the non-reserve pool is in stocks and bonds, mostly stock.
And it far exceeds the 25% threshold here. It's almost 50-50.
And I would say to the board, that was a requirement, put it in some point in time. At some point, we ought to review whether we agree with it or change it, but not today. But that is our policy.
Yeah, that's a good point. That's a good point, Mike. Mike, part of that was the county. We met with the county and they had us put some parameters in too. So, but we can always go back to the county. It's been, 10, 15 years since that happened.
Thank you.
Last thing we have on our agenda is just a brief overview of your equity portfolio. So this page here just shows Clearstead's investment resources. We have a dedicated investment research team of 25 individuals. And the following page just summarizes our due diligence process. So this process is used to evaluate both your existing managers as well as prospective managers in the larger investment space. Our research office conducts between 800 to 1,000 manager meetings a year. So they dedicate a lot of time here. And the 5P process that's spelled out at the bottom of this page is a framework that looks at both qualitative and quantitative factors that we use when underwriting managers. So on the following page, we have a look through of your domestic equities. You'll see your managers in the appendix if you are interested, but you have 7 managers in your domestic equity sleeve. You have passive investments in US large and mid caps, as well as active management in your small caps and value investments. I'll just highlight some key points on this page. This is a very low cost area of your portfolio with a lot of passive investments, and total investment management fees here come out to 0.19%. Your domestic equity is a little bit overweight mid cap, but overall positioning isn't very far off from the Russell 3000 index. And this is a very well diversified area of your portfolio. Your largest overweight is to healthcare, but it's only a 1% overweight, so very marginal. On the next page, we show the same analysis for your international equity sleeve. You have 2 managers here, both active managers. One is a value-oriented manager, Transamerica, and then you have Vanguard, which is your international growth manager. Total investment management fees here are 0.6%, which is relatively low for active management. This area of your portfolio is overweight mid and small caps, which we think is an attractive place to be invested in right now. Geographically, you are tactically underweight emerging markets. So as you may remember, last year, we did eliminate your dedicated emerging markets manager, but you do still have a 10% exposure there, although significantly underweight the broader benchmark. You're overweight developed Europe, and then sector-wise, you're fairly well diversified, although you do have an overweight to consumer discretionary and underweight to financials, which is just based on stock selection by your managers. Does anyone have any questions there?
Any questions? Okay. Being none, no questions. Thank you, Blake and Ms. Chu for that. All right. Well, thank you, Klerstad, for that fine report. And so now we are going to move on to Mr. Hollins. He's going to talk about the fiscal year 2024 unaudited and the financial statement and the January 2024 interim financial report. So Derek, go ahead, take it over.
Thank you, John. And let me underscore preliminary and unaudited. The books are currently with our independent CPA firm, and the audit is going well, and we do not expect the numbers to move, but we are not the auditors. So let's get started with just a flyover of the KPIs. Nearly all of the KPIs have performed very well in comparison to last year, 2023. So when you do the same store look back comparison, we have done well. And I would put that in context is that statistically we were set to lose money when we set the budget, when we set the statistics, and once we get to the numbers, you will see that we did generate a loss that is very explainable, and I'll get to that. On a budget basis, the green line flowing across the top is our budget, and then you have the bars representing the actuals. It's busy, but if you look for a pattern between 2022, 2023, 2024 as it relates to our best 2 months. They would be different every year. So what was our best months in 2024 there would be a slightly different flavor on 2023, and there would be a slightly different take on 2022. Before COVID, it was pretty predictable, the busy season and how activities would flow, and life hasn't been as predictable since COVID. And if I might take you to the ED, it's perhaps the only KPI that we have that we track as a measure of indicator of success that has exceeded the pre-COVID marks. So, and it has been, we've been able to project and predict it better. And here I'll call your attention to the bottom of the page, the box below the rectangle. You can see as you go through the various years, 2022, 2023, 2024, there has been increasing demand for our services, and that we have exceeded our 2024 budget in the ED. So that is what we'd like to see in all of our statistical, our KPIs. And moving on to surgical cases, we have struggled to meet our green bar, our green line that flows across the amounts. But when you look below at whether or not, when you compare actual to actual, you also see that there's been increasing demand for the services that we provide. 2023 is more than 2022, 2024 is more than 2023. Our budget, we fell short of, and that's management in terms of how we set the budget. And we worked on that a great deal. And I think we're in a better place this year because we had to stomach it for a whole year of not being maybe as practical as we could have been. And this is probably the poster child for it. And it's when we get into Metro Way Forward, which is much further on the agenda, we'll talk about efforts that we are deploying that we think will unleash capacity so that that we will be able to get more cases flowing through the ED. We believe the volumes are there. I mean, through the through the OR, we believe that the volumes are there. So moving to outpatient, and I'm going to start at the bottom and work my way up to the bars, the rectangle. What you see is that in-person visits, the demand for in-person visits have been increasing year over year over year. And for in-person, our budget could have been a little bit more practical. And the telehealth under COVID, it really became prominent, and it has fallen off. It started to fall off, and we believe we've stabilized it. And now telehealth is beginning to grow, and I think I could say that it's attributable to the rollout of Ovation. And so we have an organized effort that is, I believe, year one, Dr. Charlie?
Yeah, April will be full year.
Yes, so there's promise here. And we are still trying to understand how the downstream impact of services impacts the income statement. We understand that if the person is in person, that shows up, we have a much better understanding. We have a lot of history on the downstream impact of revenues and services. In total, you put the two together on total outpatient visits, and we've had increasing demand year over year over year for outpatient services. And this is a activity or a service that is growing across the entire market. And so we are growing consistent with the market as well. The pharmacy, 340B, we're going to talk about it a little bit today. It has been our darling. It has shown tremendous year-over-year growth. And it seems it appears that almost every month we do better than the month before. So it is growing pretty rapidly on a monthly basis. And FTEs, we are below budget, but as you can tell, we have had pretty strong growth over the blue bar, and which is 2022, and the green bar, which is 2023. And some of that, such as opening the behavioral health hospital and adding 200 FTEs to that. Some of it is pharmacy. Pharmacy is growing. We're placing bets, and we have new stores up and coming, and it takes time for them to ramp up. And so we do understand where the FTEs are in the volumes. So let's talk about the numbers. So we had budget actual. We beat total operating revenues by $19 million. And we also grew 8% net over the same period last year, which we call 2023. In net patient revenues grew almost 10%, and pharmacy almost 18%. And in total, it allowed for us to generate 8% growth. So we will report, and this will be slightly different in the audit, in the auditor's statements, because these are management statements, and there will be some classification, modest differences. But we have generated $1,966 in revenues. So what did it cost us to generate that revenues? It cost us in total operating expenses $2,016,000. So that is the challenge ahead of us. When you look at the P&L, I'd like you to look at it from the perspective of controllable areas where management has a great deal of short-term control over, and then there's the uncontrollable, which is depreciation. We clearly like the Glick, we made that decision and depreciation is coming through, but it is gonna amortize over the next 25 years. But the controllable, which is operating expenses before interest, depreciation, and amortization, that 1,862,000,000, we do have some influence over that in the short term. EBITDA for the year, which we track 104 EBITDA for 2024. We fell short of our budget of 140 and fell behind last year of 136.7. Let me go back to actuals. It's in a few places. It's where it exists, if I might, is that it is in the employee benefits. And then if you net the pharmaceutical line of 45,894 and the pharmacy revenues, you get about 20. You get about $20 million. And you take the $20 million and let's just add it to that employee benefits, which is mostly our employee health insurance, which I know we're in that business, but it's expensive. And that's about 25 million. You take that 25 million, if you add it to our EBITDA of the 104, then you get 139, and we are sitting right there on our EBITDA. And these are our challenges as we move like into 2025. We're trying to scrub it out. We're trying to fix it's almost like whack-a-mole. We've taken fixed a lot of issues from 2023. New issues appear in 2024. We think we fixed many of these issues in 2025 by making changes in terms of how we consume resources and how we allocate resources. And so when you look at the operating loss moving ahead, that's after depreciation and interest, then we have a $50 million loss compared to a budget of 22.6, and compared to 2023, which is 21.8, which we moved in the wrong direction, and we moved there because we had a $160 million contribution margin for pharmacy, and we ended up with 140, and that's how I got that $20 million variance. So we had some significant margin erosion just on retail pharmacy, and you're going to hear there's reason to pay attention to activities relative to retail pharmacy moving forward. We've adjusted 2025 for the margins, the margin erosion relative to retail pharmacy. And then I have two more numbers, and then I'll move through January faster, but I just wanted to walk you slowly through this one. So then income or net income before OPERS, actuarial adjustments. So out of the $2 billion in revenues that we generated, we are losing about $5 million. We want it to be black ink, but it is essentially break even with a little bit of red ink. And of course, last year, this time, we had black ink of 156. And I have to talk about OPERS, actuarial adjustment. That gets pushed down to us from the state, and we took a $30 million hit this year, and the year before, we took a $38 million hit. And given what the market we were hopeful that it would have been close to neutral, but it wasn't. And that's December, and I'll stand for questions.
Derek, John, just to explain the OPERS, how that works, it really doesn't affect our bottom line. This is where it's just divided among all the hospitals. So not to panic, right?
Well, yes, it's unless the.
You're talking about gas.
Yes, unless the state changes, we're not really, the law, we're not truly obligated for it. And it is pushed down to us and all the government agencies, all the municipalities, if I might, Sharon, you might, we're gifted with this every year.
Yes, they force you to accrue it, but you don't have to actually pay it.
Yes. And it's understood by the market, it's understood by the rating agencies that it exists. And you can't say no to the gift. You have to receive it and put it on your books. So John, I was gonna stop, but now I just want to do two more things, then I'll
Sure.
Let me move ahead to.
Mr. Summers had a question.
Oh, I'm sorry.
Yeah.
Mike.
Actually, you partially answered one, so, and I looked to Sharon on this. So what percentage is OPERS funded in the state? About 65%? And we're basically booking the additional, the unaccrued, the unpaid for, unfunded piece, I guess is the question. Is that correct?
That's correct. What we're booking is when they calculate the liability of the OPERS payments over a period of time, when they do their actuarial, they split that amount that they believe the municipalities and the hospitals should be responsible for, additional contributions above what you've already contributed. So they have you put it on your book as a liability, a potential liability, to keep the entity whole over a period of time, but they don't force you to pay it because it isn't actually required in their calculation at this time. And Derek said it best, we can't resist it. We can lobby to say, no, we don't want to pick up additional debt of other people, but they don't actually hear that.
And Mike, everybody is running from it.
Yes.
Yeah, no, I get that, but, and I remember this, but as a practical matter though, Ohio is more funded than probably most states, is that correct?
Yeah, it is. That fund, our pension fund in the state of Ohio, is extremely stable, is profitable. They're investing well. They're controlling their payments well and their cost well, and we don't have the same deficit or outlook on deficit that police and fire pension or some of the others may have, right?
Yes.
It's really the bigger question is this notion of predictability month to month. I understand from the operating room, limited resource, how that makes a big deal of how you schedule. But for the rest of the operation, how do we staff based on this forecast month to month?
I mean, there is some degree of shifting of staff that can happen, right? If census is really low, right? But in essence, we have staffing ratios that we need to maintain because you don't know at any moment's time are you going to get burn victims in or you're going to get traumas. There is a seasonality to trauma at least, but let's just look at the predictability of first quarter of 25, where usually our flu season follows what happens in New Zealand and Australia.
Mm-hmm.
They had a pretty good flu season. We're having the worst flu season in a decade, right? So even the things that we use to assist us to say, here's where we guess ourselves to be, it is really only as good as, as any estimate can be. So there is, some of it that you can work through and otherwise, that another thing that we'll see is, either our outside hospitals, how many patients will be admitted to the outside hospitals. Well, there's criteria around that. But we still have to maintain a certain level of nursing at those hospitals, because if those patients don't come, right, we can't not have enough staff, right? So those are some of the challenges that are in all of medicine.
I'm trying to more accurately understand this month-to-month view. My experience is there are very few industries where you could really be that accurate. And if this is one, that would be helpful for me to know. Otherwise, you're oversteering the ship reacting.
I'm gonna give you the counter argument. So there are disruptional innovative tools available now that predict with pretty good accuracy, about 98%. And if you, the example, when we took this journey years ago, and my prior employer was thinking about, if you want to go to the US Open in September, I can tell you right now, you can't get a hotel room in New York. And the hotels in New York can tell you right now that you can't get a hotel in Flushing or Corona or the Bronx because of the US Open, and they're booked out. So there are analytic tools now that take historical data, take current data, put it into a tool that will predict volumes into the future in 4-hour blocks going out 6 months to a year. The farther you go out, the less accurate they are. The closer you are, the more accurate you are, to allow you to begin doing some flexing. And going back to Chrissy's point, you do have to have a fire safety valve to pull in the event the burn comes in the event, there's multiple traumas occurring in the area that you're able to staff up and staff down. But I think, to me, the concern is that there should be, I've said this before to Derek, there should be some staffing benchmarks that are based on a number, not a ratio. Based, for example, surgical division staffing takes a higher workload than medical division staffing. An intensive care unit staffing takes more staffing than a medical division staffing. Emergency room staffing is different than urgent care staffing. And it's based on metrics: worked hour per patient day, worked hour per intraoperative hour, worked hour per case, worked hour per prescription filled. And that staffing then is how you should measure it. Here we're getting a raw number that says this is budgeted to actual. So I'll give you the example she gave about flu season. So you're filling institution with flu patients that are medical, that are not high acuity. Your case mix index falls, your revenue falls, but your expenses are going up. So even though you look like you're favorable in staffing, actually you're using more staffing than you probably needed to provide care to patients that would not have been as sick had you got the other patients in. So that's the problem within healthcare, Mike. It's really coming up with a model that allows you to flex to meet demand, but at the same time, the level of care, med-surg floors are not the same. A medical floor is different than a surgical floor. An oncologic surgical floor takes more care. So I would like to see data, and I've said this before, and I'll say it again, that looks at the productivity metrics to say, how is the institution doing as a whole compared to the volumes they had? Because flu season doesn't pay.
Yeah, I think that's good points, a good conversation. I'm going to tap you, Ron, to help us out with this. I think we're going to study this. We're going to take you up on your interests and offer, and kind of get you a little bit more involved. I think you make some good points. So, but we're going to move on, Derek, to cash and
All right.
Management 5.
Okay, so then I'd like to move you to cash. And which is an important measure that we did have a drop at year end, but I would tell you that we had a pay period of a payroll on the last day of the month, December 31st. And it basically is the difference in between what you see at the 700 and the 664, and how that translates into covenants. I know, Mike, you've asked me this question before, and I probably caused a little panic. I now have the exact numbers, and we are in compliance with our days cash on hand and our debt service coverage ratio. 125 for days cash on hand in comparison to 75 days, which is the bond covenant number, and 155 for debt service coverage ratio. And the bond requirement is 1.10. So I just wanted to let you know that when we're closing the books, it moves all around. And so the ball has stopped bouncing, and we think that this is it.
I just want to add one thing to that. Just FYI, just bring it full circle. You heard Clearstead speak earlier about our return in the market, and we made $30 million. That helps our cash, obviously. If the opposite were to happen, we go through a bear market, obviously our cash would reverse $30-40 million in a bad market. So just FYI, keep that in mind as we go forward and make decisions. Go ahead, Derek.
All right.
Are those variances between those numbers of concern to you, they're relatively close? Are they of any concern?
Well,
I mean, like-
I'm not losing sleep over them, but if the gap got wider between requirements and our actual performance, I would like that. And we have improved. I'll show it to you in January as well. So I can keep going.
Derek,
Just
quick
question.
question.
This is a great slide.
Derek, quick question. This is Artis speaking. Sorry for
Yes.
interrupting you. Just going back to the debt service. You mentioned the pharma business contributes about 140 million of revenue of EBITDA to the bottom line. How much of that is from the 340B sort of contribution of that 140? Is it the majority of that 140, or what's sort of that contribution to that number?
Oh, not to steal the thunder of the next presenters, but it's nearly all of it.
I'll do this.
Go ahead.
In executive session when we get to it.
Yeah, we'll
Okay,
do
never
that
mind.
executive session.
No problem. Thank you. We'll do it there.
So question, on this days on cash on hand debt service coverage. I mean, it's a fairly dramatic shift from 2021 to now. Is there what is the clearest reason for this shift? Has we just lost our profitability that dramatically? Have we added more debt coverage or debt obligation? Some combination of the two?
Yeah.
Two things. Two things. One is we use cash to invest in capital projects. The outpatient health center is one, and the behavioral health hospital, we use our own cash. And the other one is that denominator. The denominator has, which is a function of operating expenses, have been getting larger and larger because our expenses have been growing. This is what you would see across the market. If you look at Moody's, S&P, you look at all the hospitals that are being rated in absolute cash, it has been stable, and the days cash on hand has they've been eroding a little bit.
Question. And okay, go ahead.
Oh, no, John, if you got
No, keep going, please.
All right, so we won't spend time here, and actually Ron has already done this presentation in some of his remarks that he's made. And hopefully you don't get, so anyway, I'll stop here. Cash is up just in 1 month from 664 back to 688 because it simply had time to recover. Cash on hand is up from a month. It moves from 125 to 129. Debt service coverage ratio went from 155 to 160. And this is in the 30-day period. I just wanted to point that out, and I'm gonna bear with me, and I'm going to get here. and simply say, 1 month doesn't make a trend. And that, we believe that we are working on the right stuff at the right pace. We're a little bit behind in our Metro Way Forward stuff. But we're working on it. There's positive progress. So I'll stop and stand for any questions that you might have.
Any quick questions before we go into executive session? Sharon, do you have a question?
Yeah, Brian had mentioned before that we would look at the first quarter as kind of a benchmark and then maybe make some adjustments if it looks like we're, going in the wrong direction. Does that make reasonable sense to you? I know some of the Metro Way stuff is over a longer period of time, but does it make sense to you that given how we kind of landed last year, that the first quarter
Yes.
be a basis for making some adjustments?
Metro Way Forward is Plan A. We have a Plan B as well, and we will be more aggressive. And I will defer to Chrissy as well on this.
Okay.
Say some of this for executive
Yeah,
session.
yeah.
Yeah, let's, when we hold that question, we'll bring it up. This is executive session stuff, the Metro Way. So with that in mind, I'm going to thank you, Derek. We're going to move into executive session. I'd like to ask for a motion to move into executive session, discuss hospital trade secrets as defined by ORC 1333.61, and to consider the appointment, employment, dismissal, discipline, promotion, demotion, or compensation of any public employee, or the investigation of charges or complaints against a public official, and to confer with the public body's attorney to discuss disputes involving the public body that are subject of pending or imminent court action as defined by ORC 121.22. G, do I have a motion to recess into an executive session to discuss these matters?
So move.
Second.
Okay, thank you. I'm going to do the roll call. Artist Arnold.
Yes. Aye.
Okay. John Corlett.
Yes.
Maureen D. Maureen not here, right? Okay. Sharon Dumas.
Yes.
Ron Zindinsky.
Yes. Yes.
Okay. Dolores Garcia. Not here. Nancy Mendez. Is she here? No. John Moss. Yes. Mike Summers. Mike.
Sorry, 1 second. Tamika moved the boardroom into executive session early.
Oh. Tell me when I'm ready. I'm good to go. Okay, sorry,
Yes.
man. Sorry, Nancy. So with that, I'm gonna ask the public to step out, and then we are moving to, and we'll be in executive session.
See you later.
John, you can move yourself. Are you
Okay.
able to say yes? Okay, okay.
I
thank
said
you.
yes. Yeah.
Tamika, did we lose Odoto?
Can you be sure to let Dodo in?
Oh, there he is.
No, I'm here, Derek. I'm here.
Okay, thank you.
So Dodo and Philip Brooks needs to move into executive session. And then we'll be good.
One second,
Okay, John.
the room hasn't moved in yet. 1 second, let me see.
Okay.
What?
We good now? He's standing.
Right.
John, we can't hear you.
I think he's gone.
Spring.
You know, cause I can't hear because he's not on here. That's why.
Mm.
We're trying to connect you back to the room.
All right. It's not this. Well, it's easy to face to face.
Not yet, hold on for 1 second, we're trying to connect the room here. We're back, John.
Okay, we're back and thank you, everybody. The meeting is adjourned.
It's 3:01, 5 minutes. Everybody, 5 minutes. Hopefully it won't be more than 5 minutes late.